We talk about crop insurance regularly on this show. Whether you're in wheat or canola, corn or soybeans, we try to have you covered. But what if your crop doesn't grow in rows? What if you don't drill it in with a tractor? More than 50% of Oklahoma is rangeland. That's about 23 million acres. Now, these grasses are a valuable resource and one seriously threatened by drought. But they can't be insured in the same way as row crops. So to learn more about the options there are, we traveled to Ardmore and met with Extension Area Economist J.J. Jones.
There's the two basically insurance options that producers have to minimize their loss during a drought. One option is the NAP insurance that's offered by the Farm Service Agency. And the other option is the Rainfall Index insurance offered by the Risk Management Agency, which is a branch of the USDA, and which that insurance is sold through private insurance carriers.
Okay, let's talk a little bit briefly about these. First of all, NAP. Explain to us how that works.
NAP is a coverage, and it's a bare bones basic insurance coverage how it works is the producers are charged $250 per crop, and a maximum of $750 for their entire operation in one county. So if a producer had more than 3 crops, then basically it's kind of the Pep Boys, buy 3, get 1 free options.
Okay.
But for the pasture crop, it would be $250 for a warm season, $250 for the cool season components.
Okay.
And so they would insure that. And how that works with an app coverage, you go into the FSA office and you'll sign up and do the paperwork required, which is acreage reported, plant, intentions and production practices. And then from that, it would go, and if there's a payment, first of all, you have to have a 50% loss before any payment is kicked in. And then payment is based on anything less than 50% production and at 55% of the market value.
Okay. Let's talk about the rainfall option then. That's a little bit different way of doing things.
It's a little different from the standpoint that it's private insurance, so you have to go to an insurance carrier that's usually typically dealing in crop insurance. And it's a scientific-based program where they have divided Oklahoma up into 0.25 latitude and 0.25 longitude grids. Roughly 4.5 square miles. These grids do not follow county boundaries, they do not follow township boundaries, they're just square grids out there that have divided the state into Oklahoma.
National Oceanic and Atmospheric Administration data is then used to calculate the average rainfall for each grid section. And then the producer chooses the level at which to trigger that insurance, 60, 70, 80, or 90% of that total. And of course, the higher the percentage, the higher the premium.
A cattle producer who's not used to doing this type of work or insurance work is going to probably find it's a little cumbersome because you're going to be required to, acreage, total amount of acreage, how you've treated that acreage over the last little bit, what you normally get off of this acreage, things that they're, should be keeping up as far as records go, but as a general rule, probably don't. And so now they're going to have to keep up with that. And then there's certain dates that they have to remember to hit, because if they don't meet these guidelines and hit these dates, these deadlines, then they're going to become ineligible and not receive their payments.
Okay.
So the first date, for example, is November 15th. That's when producers have to sign up and basically say they're interested in the insurance and list their acreage intentions.
Right.
Okay. So, that's the first date. And that's November 15th, 2012 for the 2013 crop year.
Additionally, producers must pick two-month time intervals when rain is most important for their crop, whether it be for hay or grazing. Jones explains.
They can pick all 6, because there's two-month time periods, they can pick all 6, but generally, as a rule, they would pick the time period with their grass is growing and they need that grass production. For example, Bermuda grass, you'd want that production in the summertime. We're looking at May and June and July.
So all this is starting to sound a bit complicated, but it truly sounds worse than it is. And so Jones directed us to a tool online that can help producers make a decision about their operation. The USDA Risk Management Agency's Decision Support Tool. This calculator allows landowners to look at their grid and see how the insurance would have worked if it had been in place in recent years. That allows you to look at the numbers and become comfortable with the program before approaching an agent. You can find a link to this tool on our website, sunup.okstate.edu, or contact your county extension